Let's start with the basics of what we are doing here. Intraday trading simply means you are buying and selling stocks within the same day. You open a position after the market opens in the morning and you close it before the market shuts down in the afternoon. You do not hold any stocks overnight. This is a fast-paced game where you are looking for quick profits from small price movements. The goal is to get in, make a small gain, and get out. You are not investing in a company for its long-term growth. Instead, you are just interested in where its stock price is headed right now, in this very moment. Now, let's add the momentum part to our strategy. Momentum is like a wave in the ocean. Once a wave starts moving in one direction, it tends to keep going that way for a while. In the stock market, momentum means a stock's price is moving strongly in one direction, either up or down, on high volume. Momentum traders believe that this trend will continue for a short period. They want to jump on this moving train, ride it for a short distance, and then jump off before it stops or changes direction. It's about finding the stocks that are already making big moves today. Why do traders focus on momentum during the day? It's because intraday markets are full of noise and quick changes. A stock can go up and down many times in a single day. A momentum strategy helps you cut through that noise. It gives you a clear signal to follow, a stock that is already showing unusual strength. This strength often comes from some news, a good earnings report, or a lot of attention from other traders. By focusing on these strong movers, you increase your chances of being on the right side of a trade, even if it's only for a few minutes or a couple of hours. So, when we combine these two ideas, we get intraday momentum trading. This is the art of finding stocks that are making powerful moves on the current trading day and then trading them to capture a piece of that move. You're not trying to predict the future. You are simply reacting to what the market is telling you right now. You see a stock that is climbing fast with lots of people buying it, and you decide to join the party. The key is to be quick, disciplined, and ready to exit your position as soon as the momentum starts to fade away. Every good trader needs a plan. A basic intraday momentum strategy can be broken down into 3 simple steps: selecting the right stock, knowing when to enter the trade, and knowing when to exit. The first step, stock selection, is the most important part of your morning routine. Before the market even opens, or in the first 30 minutes of trading, you need to find stocks that are already showing signs of strong momentum. We will cover how to find these stocks in more detail in the next section. For now, just know that your goal is to create a small watch list of potential candidates for the day. Once you have your watch list, the next step is your entry point. You don't want to just jump into a stock because it's moving. You need a specific signal to tell you now is the time to buy. A simple entry signal is to wait for the stock to break above a key price level from the pre-market session or the first few minutes of trading. For example, if a stock hits a high of $52 in the first 15 minutes, you might place an order to buy it if it moves above $52.10. This breakout confirms that the momentum is continuing and gives you a clear point to start your trade. After you have entered the trade, you must immediately think about your exit. You need 2 exit points, one for taking profits and one for cutting losses. For your profit target, you can set a specific goal, like a 2% gain, or watch for signs that the momentum is slowing down. For example, if the stock price starts to stall or the trading volume decreases, it might be time to sell and take your winnings. This is not the time to be greedy. Remember, the goal is to capture a small, quick profit from the momentum wave. The most critical exit point is your stop loss. This is the price at which you will sell the stock to limit your potential loss if the trade goes against you. For instance, if you buy a stock at $52.10, you might set a stop-loss order at $51.80. This means if the stock price drops to that level, your position is automatically sold. This protects you from a big loss if the momentum suddenly reverses. Using a stop-loss is non-negotiable. It is your safety net and the most important tool for staying in the trading game for the long run. Finding the right stocks is half the battle in momentum trading. You are looking for stocks that are in play for the day. A great place to start your search is with a pre-market scanner. Many trading platforms offer tools that show you which stocks are moving the most before the market officially opens at 9:30 a.m. Eastern Standard Time. You should look for stocks that are gapping up or gapping down. This means their price is significantly higher or lower than where it closed the previous day. This gap is often caused by overnight news, like an earnings announcement or a product launch. Another key ingredient to look for is high relative volume. Volume tells you how many shares are being traded. High volume confirms that many traders are interested in the stock. You want to find stocks that are trading with much higher volume than they normally do. For example, if a stock usually trades 50,000 shares in the first hour, but today it has traded 500,000 shares, that is a strong signal of unusual interest. High volume gives power to the price move and makes the momentum more reliable. Look for stocks with volume that is at least 2 or 3 times their average. Don't forget to pay attention to the news. The stocks that make the biggest moves often have a fundamental reason behind them. Check financial news websites or your trading platform's newsfeed for headlines related to your potential stocks. Is there a positive earnings surprise? Did the company announce a new partnership? This news acts as a catalyst that attracts a flood of buyers and creates the strong momentum you are looking to trade. A stock moving on a clear news story is often a much better candidate than one moving for no apparent reason at all. Finally, keep your watch list small and manageable. At the beginning of the day, you might find 10 or 20 interesting stocks. Your job is to narrow that list down to the best 2 or 3 candidates. Focus on stocks that have a clear catalyst, high relative volume, and a clean price chart that is moving smoothly in one direction. It is much better to closely watch a few high-quality setups than to get overwhelmed by trying to track too many stocks at once. Quality over quantity is the key to successfully finding your star players for the day. In trading, a good defense is more important than a good offense. Your number one job is not to make money, but to protect the money you already have. The most important defensive tool, as we mentioned, is the stop-loss order. You must use it on every single trade. A common rule for beginners is the 1% rule. This means you should never risk more than 1% of your total trading capital on a single trade. For example, if you have a $10,000 account, the most you should be willing to lose on one trade is $100. This helps you survive a string of losing trades. Another important risk management technique is to know your profit-to-loss ratio. This means the potential profit on a trade should be greater than your potential loss. A good starting point is to aim for a 2-to-1 ratio. If you are risking $100 on a trade, your profit target should be at least $200. This ensures that even if you are only right on half of your trades, you can still be profitable. If your winners are bigger than your losers, you have a mathematical edge that will help you succeed over the long term. Avoid trades where the potential reward isn't worth the risk. It's also crucial to know when to stop trading for the day. Even the best traders have losing days. If you hit your maximum daily loss limit, which could be 2 or 3% of your account, you must stop trading immediately. Turn off your computer and walk away. Trying to revenge trade to win back your losses is one of the fastest ways to blow up your account. Similarly, if you have a great winning day, it can also be wise to stop trading. Don't get overconfident and give back your hard-earned profits by making sloppy trades later in the day. Finally, you need to understand that this strategy is not for everyone. Intraday momentum trading requires a lot of time, focus, and emotional control. It is best suited for individuals who can dedicate several hours to the market each day, especially during the opening hours. You need to be able to make quick decisions and handle the stress of a fast-moving environment. This strategy is likely not a good fit for someone who wants to trade passively or cannot watch their positions closely. It is for the active, disciplined, and resilient trader who is prepared to treat it like a serious business.